Did you know that 2024 saw the most significant market drop since 2008? While many saw it coming, others were caught off guard by the magnitude of the crash. But what really caused the market to tumble this year, and how can we learn from it? In today's video, we'll break down the factors that led to the 2024 market crash and explore what it means for investors going forward. Welcome back to the channel. Today, we're diving into one of the most important financial events of the year, the 2024 market crash. Whether you've been directly impacted or are simply curious about what happened, understanding the factors behind this market downturn is crucial for anyone looking to navigate the world of investing. In this video, we'll explore the key causes of the crash, compare it to past market collapses, and discuss how these events could shape the financial landscape moving forward. So, what exactly went wrong in 2024? Before the crash, the global economy was already under pressure. Several factors had been building up, creating the perfect storm. One of the major issues was rising inflation rates. As central banks tried to rein in inflation, higher interest rates began to strain both consumers and businesses. This in turn led to slower growth and declining consumer spending, which is one of the key drivers of economic health. At the same time, geopolitical tensions were escalating, particularly in key regions affecting energy supplies and trade. This uncertainty caused shockwaves throughout global markets. On top of that, many sectors had seen overvalued stocks, driven by years of low interest rates and speculative investments. As investors realized the market was becoming overheated, they began pulling out, which contributed to a sharp sell-off. These are just some of the problems that built up before the crash, but what pushed it over the edge? Let's dive deeper into the causes of the 2024 market crash. One of the major factors was inflation. Throughout 2023, inflation had been rising steadily, largely driven by supply chain disruptions, labor shortages, and rising commodity prices. In response, central banks like the US Federal Reserve and the European Central Bank began raising interest rates aggressively to try to combat inflation. But with inflation still stubbornly high in early 2024, these higher interest rates started to take a toll on both consumers and businesses. With higher borrowing costs, companies found it harder to finance expansions or manage their debt, while consumers had to cut back on spending as mortgages, credit card rates, and personal loans became more expensive. The combination of slowing economic growth and higher interest rates caused investor confidence to weaken, leading to the first wave of sell-offs. Another contributing factor was geopolitical tensions. Specifically, tensions between major oil-producing nations led to concerns about energy supply disruptions. The resulting spikes in oil and gas prices increased production costs across multiple industries, further squeezing corporate profits. The energy sector, which is typically seen as a safe haven in uncertain times, also faced challenges, adding fuel to the market downturn. Additionally, many experts pointed to the overvaluation of tech stocks as a significant factor. Tech companies had seen a massive surge in value during the previous decade, especially during the pandemic, when remote work and digital services became essential. However, as we moved into 2024, many of these companies were not able to maintain their growth projections, and their stock prices began to look increasingly unsustainable. This resulted in a massive tech sell-off, which then rippled through the broader market. Comparing the 2024 crash to previous crashes like the 2008 financial crisis, there are some interesting similarities. In both cases, speculative investments in overvalued sectors played a role. But unlike 2008, which was primarily driven by the housing market collapse, the 2024 crash was more of a macroeconomic event driven by inflation, rising interest rates, and global instability. While different in nature, both crashes illustrate how quickly markets can turn when economic fundamentals are stretched too thin. Now, let's talk about the turning point that triggered the 2024 crash. Many analysts point to the release of a key employment report in early February, which showed much weaker than expected job growth. This was a major shock to the market, as investors had hoped that the labor market would remain resilient despite the rising interest rates. The weaker employment data signaled that the economy was slowing down faster than anticipated, prompting widespread fears of a recession. At the same time, the U.S. Federal Reserve released comments suggesting that more interest rate hikes were on the horizon, with no clear end in sight. These two events happening in the same week sent the market into a panic, with investors rushing to sell off riskier assets. Major indexes like the S&P 500 and NASDAQ fell by over 10% in just a few days, and the sell-off continued as the fear of a prolonged economic slowdown gripped the market. This key moment, when both macroeconomic data and central bank policy converged, was the tipping point that led to the full-blown market crash of 2024. So, what can we learn from the 2024 market crash? It was a perfect storm of rising inflation, high interest rates, geopolitical tensions, and overvalued stocks that ultimately led to the downturn. The crash serves as a reminder of the delicate balance between economic growth, inflation, and central bank policies. It also underscores the importance of keeping a close eye on key economic indicators like inflation, employment, and central bank decisions when assessing market risk. As we move forward, investors will need to be cautious, paying attention to how central banks respond to inflation and whether geopolitical tensions ease. While market crashes are always unsettling, they also present opportunities for savvy investors who can navigate these volatile periods with a clear strategy. What do you think about the 2024 market crash? Were you caught off guard, or did you see the signs coming? Let me know your thoughts in the comments below. And if you want to dive deeper into topics like inflation, interest rates, and market volatility, check out my other videos for more insights. Don't forget to subscribe, like, and hit the notification bell so you never miss an update. Thanks for watching, and I'll see you in the next video.